And joining us today is a very special guest, Arnab Das, Managing Director of Research at Roubini Global Economics. Arnab, hi, afternoon. Always good to have you on the show. The trade data here in India for the month of September has come in at a good 30-month low. Would it be too early to assume that, though, that India's current account deficit problem is over for now?
Well, I think it's clear that the tightening in financial conditions caused by the capital outflows and by the measures that the central bank has taken, as well as the fiscal consolidation, are constraining domestic demand, and so helping the current account. Plus, the depreciation of the rupee is making exports somewhat more competitive. But I would say it's too early to sound the all clear on the current account. The issue is that the international environment for capital inflows still remains, fairly uncertain and volatile, because eventually tapering by the Fed is still on the horizon, and in the immediate future, there is this kind of fiscal and political crisis in the United States, which is causing some uncertainty and volatility again in capital markets.
Say that the $70 billion target that's been set for the current account deficit for FY14 now looks a little more credible?
Yeah, I mean, I think it is coming more into line with that sort of a target. I think the thing to emphasize here, though, is that the current account deficit is still large in relation to the size of the Indian economy, even at $70 billion. It's also one of the largest absolute size current account deficits in the world of emerging markets, if not the largest. Now, of course, that shouldn't matter. It should be scaled relative to the size of the economy. But, of course, the absolute size of short-term portfolio capital flows, which is what the financing still consists of India's current account deficit, the absolute size is going to be hit when and if the Fed tapers, and when and if this budgetary impasse in the United States isn't resolved. So what I would say, emphasize here, is that the adjustment in the current account is on track, but the capital inflows that are financing that current account deficit have become somewhat more uncertain at the margin than they were just a few weeks ago. So I think the riskiness is still there.
Arnab, what about the currency? Because that definitely has cheered the trade data this afternoon. Could this mean further strength in the currency, or does it seem like just a knee-jerk reaction?
I think part of the story in emerging markets as a whole, and India in particular, is that a number of prices had become significantly more attractive. So the currency valuation, the value of equities, and the value of bonds in many countries, including India, where they're open, or to the extent that they're open to foreign investors. So I don't think that there's going to be another immediate big sell-off in the rupee. Maybe there'll be some more upside in the short term, subject to the caveat that the U.S., I keep emphasizing this, that the U.S. gets its house in order before the debt ceiling is breached. If the debt ceiling is reached without an increase in the debt ceiling on the 17th of October, then it is quite likely that the U.S. will have to make a major fiscal adjustment very quickly in order to remain current on its debt. And it will be very difficult to prioritize payments. That will cause a big shrinkage in the growth of demand, or maybe even the level of demand in the U.S., and that will ripple throughout the world.
Arnab, just picking up on the point that you made a little while ago on one of the reasons that has caused the current account deficit to shrink is the monetary tightening steps that were taken by the central bank as well. And that's obviously going to have an impact on growth as well. Last evening, we had the IMF cut India's growth estimate for FY14 to 3.8%, which is way below what the government is looking at. What is your own sense? How bad is it looking as far as the economic growth is concerned?
Well, I think the particular point forecast is one issue, and I would tend to agree that is indeed a quite bearish forecast, and it's somewhat below our forecast as well. The IMF has cut a number of forecasts: global growth, emerging markets overall, and India in particular. And I think the main message here, rather than the point forecast, is the direction of travel, right, and the speed at which these forecasts are being revised down. And I think, what we're seeing here is a belated recognition that emerging markets after the crisis were growing well above their potential for a world that was much more credit constrained than it had been before the crisis. in the immediate aftermath of the crisis, once the financial situation had been resolved, the consensus view was emerging markets could do no wrong. Their balance sheets were strong. They had sort of gotten religion from the previous crises in the 1990s, starting with India's crisis in 91. Well, in retrospect, it's becoming clear now that that wasn't really the case. Many emerging markets used the opportunity, or ended up at least in the position of using all of these capital inflows to finance a big impact on growth, and in particular on consumption and investment, leading to these external imbalances that can no longer be financed. So growth has become dependent in the deficit countries, including India in particular, on those inflows. With those inflows reversing, stopping or even reversing and significantly reducing over time, that sends the signal that cyclically growth is going to be significantly lower than it was. And two, more importantly, that the potential growth rate is lower than most of the world thought it was. To raise the potential growth rate back to where the expectations were in the immediate aftermath of the crisis, and here we're not just talking about India, it's also China, it's also South Africa, it's the rest of the BRICS, it's also the middle-sized emerging market countries. They're going to have to go through another serious round of reforms. And this is where I continue to have doubts that India and other countries will be able to deliver in a reasonable time in the absence of a more serious financial imbalance of payments crisis.
Arnab, let's talk about the crux of the issue, which again is the Fed tapering, which is indeed, inevitable. When can one expect it to start? Would it be as early as December, or do you think it will be pushed to next year?
Well, I think this is now critically dependent on what happens between the White House and Congress. Right, so as everybody knows, there's a big fight about the shutdown of the federal government in the United States, and also this critical issue of whether the U.S. will end up raising the debt ceiling in time. And of course, as we've gotten closer to the deadline, positions seem to be hardening. Now, of course, that's all part of the political theater of the absurd that's going on, and I think eventually it'll go right down to the wire, and eventually they'll strike a deal at the last minute, like they did in 2011. But there is a risk, however small a risk, that the debt ceiling isn't raised, that the shutdown continues, and that there has to be a larger fiscal adjustment. If all of these things happen, in order to remain current on the debt, if all of these things happen, so that's kind of a worst case scenario, but we have to consider it, then the drag on demand could be quite significant, right? It could be on an annualized basis some 4 or 5% of U.S. GDP, equivalent to the collapse in output that took place after the Lehman bankruptcy, right? Now, so if that happens, then tapering is very likely to be pushed back into 2014, rather than taking place this year. If that doesn't happen and good sense prevails and this game of chicken ends well, then I think we could see the tapering coming maybe in December or early 2014 rather than later on in 2014.
But right
so
now,
I think the Fed now has become, like all the rest of us, hostage to the politics of fiscal policy in the United States.
Mm-hmm. But right now, Arnab, the big concern is the fact that there seems to be no breakthrough to the political stalemate in the U.S. At what stage do you think will global markets start pricing in the possibility of the U.S. defaulting? I know it sounds really scary, but at what stage will markets start pricing in that possibility?
I think what people are pricing in now is a rising risk of some sort of event, but still a very small risk, right? So the short end in the U.S. has backed up, various kinds of key players in the money market instruments and the treasury bills have clarified that they have exited that market or at least a part of that market for the time being. So I think people are finally beginning to react to this risk. Now, pricing this risk in fully, I think, is impossible, right? The planet is intrinsically long U.S. treasuries. In reserves, there's a supermajority, something like 2/3 of central bank reserves around the world, more in some countries, less in others, is held in U.S. treasuries. And of course, treasuries are the main collateral for all of the trading or most of the trading that takes place in the private financial system, certainly in the Western world and even in emerging markets to a large degree. So I think there's no way that the financial system, in any major economy or in the world as a whole, can really protect itself from a U.S. default. I think in the end, if there is no agreement reached on the budget or on the debt ceiling, then the most likely short-term outcome is that the Treasury starts to prioritize payments and tries to make good on the debt, right? Keeping the stock of debt constant, refinancing the maturities, and paying the interest out of current revenue. And that's where we get the massive fiscal drag. And I think even that, without the dangers and the volatility of a financial collapse, even that would raise a lot of uncertainty. One effect would be how bad is the economic outcome or the economic implications of that for the U.S. and other countries, because the U.S., after all, is still the world's largest importer, and it'll be quite significant. Like I say, it could be 1% of GDP in the fourth quarter, for on an annualized basis. And the uncertainty about how long this could go on after we've crossed that kind of cliff into potentially staring into the abyss of a default, that's going to create a lot of potential turmoil, right? Now, as I say, chances of that happening are very low, and if it does happen, it would imply that the Fed would taper later. However, in that environment, even though the Fed is tapering later, it's not at all clear that that would be good for emerging markets in the immediate future, right? This would be a risk-off kind of situation because of the economic drag and the financial uncertainty emanating from this fiscal crisis.